The Rule of 16. Options Trading Shortcut. Options trading often feels complex because it blends mathematics, probability, and psychology into a fast-moving marketplace. Yet within this complexity, traders constantly search for shortcuts that simplify decision-making without sacrificing accuracy. One of the most useful and surprisingly simple shortcuts is the Rule of 16, a mental math technique that helps traders quickly estimate daily price movement using implied volatility. This small calculation can dramatically improve your ability to choose strike prices, manage risk, and plan trades with confidence. The Rule of 16 is not magic, but it is practical, efficient, and widely used by experienced traders who need fast answers without opening spreadsheets or calculators. At the heart of options pricing sits volatility, the market's expectation of how much a stock might move. While beginners often focus on direction, professionals focus on movement size. Options become valuable when price movement exceeds expectations. That is why traders constantly analyze implied volatility to estimate how far a stock could realistically travel. However, implied volatility is quoted as an annualized percentage, which makes it difficult to translate into daily expectations. This is where the Rule of 16 becomes incredibly valuable, because it converts yearly volatility into a simple daily estimate in seconds. The Rule of 16 states that you can estimate a stock's expected daily move by dividing its annual implied volatility by 16. The number 16 comes from the square root of approximately 256 trading days in a year. This mathematical shortcut allows traders to skip complicated formulas and quickly understand expected price movement. For example, if a stock has an implied volatility of 32%, dividing by 16 gives a daily expected move of 2%. That means traders expect the stock to move about 2% up or down in a typical trading day. Just a quick reminder to please hit the like button and subscribe to the channel for more content like this. Also, you can visit us on the web at investmentees.com and use code BLOG to receive 20% off your next purchase. Although the Rule of 16 sounds simple, it is grounded in solid statistics. Market volatility scales with the square root of time. Since there are roughly 252 trading days in a year, the square root is approximately 16. This means annual volatility divided by 16 gives a rough daily volatility estimate. This shortcut works because traders care more about speed and practicality than perfect precision. In fast markets, a quick estimate often beats a perfect calculation delivered too late. Once you calculate daily percentage movement, converting it into dollar terms becomes easy. Suppose a $100 stock has 32% implied volatility. Dividing by 16 gives a 2% daily move. 2% of $100 equals $2. This means traders expect the stock to move roughly $2 per day. This knowledge helps traders determine whether options are cheap or expensive, whether a strike price is realistic, and whether a strategy fits the expected range. The Rule of 16 shines brightest before placing a trade. Imagine you want to sell options and collect premium. You need to estimate how far the stock might move before expiration. By using this shortcut, you can quickly determine whether a strike price sits safely outside the expected range. This helps traders avoid emotional decisions and rely instead on probability-based thinking. Over time, this shift from guessing to estimating becomes a major advantage. Earnings season creates massive volatility spikes. Traders often wonder whether options are overpriced or underpriced during these events. The Rule of 16 helps estimate daily movement leading up to earnings and compare it to the expected post-earnings move priced into options. This comparison allows traders to identify opportunity, especially in strategies like iron condors, straddles, or credit spreads. Risk management is the backbone of long-term trading success. By estimating daily movement, traders can adjust position size to match expected volatility. High volatility environments demand smaller positions, while lower volatility allows for larger exposure. The rule of 16 becomes a risk compass, guiding traders toward consistent position sizing rather than emotional trading decisions. Choosing the right strike price can feel overwhelming. Too close to the current price and risk increases. Too far away and profit shrinks. With the rule of 16, traders gain a realistic sense of how far a stock might travel within a given time frame. This transforms strike selection from guesswork into a structured process grounded in statistical expectations. This shortcut works beautifully alongside common options strategies. Credit spread traders use it to determine safe strike distances. Iron condor traders use it to define expected price ranges. Straddle traders use it to evaluate whether the expected move justifies premium costs. The rule of 16 acts like a universal translator, converting volatility into actionable trade planning. While powerful, the rule of 16 is still an approximation. Markets can move more than expected, especially during news events or sudden sentiment shifts. Traders must remember that volatility represents a probability range, not a guaranteed boundary. Understanding this limitation prevents overconfidence and encourages traders to combine the shortcut with broader analysis. Many new traders believe success comes from complex indicators and sophisticated models. In reality, successful traders often rely on simple tools they can apply consistently. The rule of 16 stands out because it is easy to remember, fast to calculate, and practically useful in daily decision-making. Simplicity reduces hesitation and builds confidence, which ultimately improves execution. Conclusion: the rule of 16 proves that powerful trading tools do not need to be complicated. By converting annual implied volatility into daily expected movement, traders gain a fast and reliable way to evaluate risk, choose strikes, and plan strategies. While it is not a crystal ball, it is an incredibly practical shortcut that improves decision-making and encourages disciplined trading. When used consistently, the rule of 16 becomes more than a formula. It becomes a mindset rooted in probability, preparation, and confidence. Thank you for watching.